So hello everyone, I hope you guys can hear me. If you cannot hear me or cannot see the screen, please let us know. Otherwise, I just go ahead now, okay? So welcome to today's webinar on how to make money in a recession. And welcome back to everyone who has been here with us before. I think it was 3 weeks ago when I was doing my first webinar with you on how to trade like a market wizard. If you haven't watched the first webinar yet, I would actually encourage you to do so. I'm not sure, but maybe you find the recording from the previous webinar on Equity's YouTube channel, maybe. Well, maybe you can just ask someone from Equity to provide you with the details, but I would encourage you to watch the previous webinar, because the webinar 3 weeks ago, that was very basic, but it was very foundational. So today we are going all in. Okay, ladies and gentlemen, we are going all in, expert level knowledge and skill. So please, if you are a beginner or intermediate, don't feel intimidated or discouraged by today's webinar. It just shows that you have to learn a lot, and everyone at some point starts at zero, right? So before I even start with an agenda, I would like to confront you with a little quote, because especially right now, a lot of people approach me and say, well, there's nothing I can do about it anyway, or we are just doing fine. Well, I think we are doing, we are far away from doing fine. We are, I would say, in some kind of magic mushroom interest bubble. Rand put it very nicely when she wrote, let me quote her, "You're free to ignore reality. You're free to distract your mind from any focus and stumble blindly down whatever path you want. But you are not free to avoid the abyss you refuse to see." And our society globally refuses, in my opinion, to see the abyss it is rapidly approaching, even though the signals are getting louder and louder day by day, month by month, and are becoming more threatening, not only in economics and monetary policies, but also in all other fields of politics. Today, of course, we are not talking politics, but economics and monetary policies. So this state of, how I would like to say, delirium and intoxication we are in, is a result from the zero and negative interest rate policy that we have now, especially in Europe for a longer period of time, but now also in other areas, in this world, in the US as well. So we believe, or I believe, that the central banks, or we in general believe, that the central banks have found the holy grail and can make the economy work again. We believe that the central banks could control everything. And today, I want to make the case that Europe's banking sector is the epicenter of the next market crash, and that the coronavirus is just the trigger of what is supposed to happen anyway. So we are going to have two sessions together today. That's the agenda for the first session, which might last 40 to 50 minutes. First, we speak fundamentals, the reason for the mess we are in. And in the second session, we're going into the live markets and see how we can trade this mess and benefit from the current situation. So in 5,000 years of written accounts of human history, the interest rate has never been negative, but now it suddenly is negative, and they want to tell us, the politicians, the central banks, they want to tell us that they have everything under control. They want to tell us that nothing could happen. So the zero interest rate and negative interest rate policies ruin the financial performance of banking institutions and lead to a zombification of the economy. The zombification of the economy results from the fact that businesses can no longer go bankrupt since they are subsidized by the zero interest rate. And I'm going to show you some numbers on that in a moment. Businesses that should actually go bankrupt but don't are obviously inefficient and unproductive and produce things literally that nobody needs. They, what we call it, zombify the economy and inhibit economic and technological progress. So these zombies, right, inefficient companies, that's what we call zombies, then accumulate as actually poor but supposedly good credit customers in the books of the banking institutions, contaminate them, and create an enormous risk time bomb, urging to explode. So I'm also going to show you how this time bomb will unfold over time and how we as professional traders and investors can benefit from that, especially in the second session of today when we go into the live market and see how we can trade that. So let's start with the natural rate of creative destruction, how we call it. So in economics, there's a so-called natural rate of creative destruction. The natural rate of creative destruction is about 1.5 to 2%. So this is the number, the 1.5 to 2%. This is the number of companies that go bankrupt each year. So out of 100 companies, on average, 2 fail and are sorted out each year. And that's obviously healthy because the resources associated with them, such as human capital and financial assets, are released to seek new activities in the whole economy. And this is also necessary because the companies that fail are inefficient and produce things that nobody needs, or they basically do it too expensively. They have to go bankrupt because inefficient companies that survive will, metaphorically speaking, will eventually clog the arteries of the economy. So the following has happened. Now, the following has happened as a result of that zero interest rate policy in the European Union. So before the 2005-2006 housing bubble, we had company failures that were below the long-term average. It was about 1.2%. Let me get my laser pointer and show it to you actually on that chart. Sorry. So you see here, I hope everybody sees my laser pointer. You see here the long-term average, right, between 1.5% and 2%. And in the failure of companies, of inefficient companies in before the housing bubble in 2005-2006 was about 1.2%. So which was normal because in boom times, obviously the defaults are lower than in times of crisis. That should be self-explanatory. And then the crisis came. So what should have happened in the crisis? In 2007 and 2008, the defaults should have gone up above the long-term average. Long-term average, 1.5 to 2%. And after that, the recovery usually follows. So normally, this is a fluctuating curve close to this range with a bandwidth for defaults to go below and above the long-term range. As you can see, and that's now very interesting, as you can see, exactly the opposite has happened. After the housing bubble, there was a small increase only. It didn't go all the way to the long-term average or above during the crisis. No, there was only a small increase of 0.1% that you see here. That's the small increase. And since then, it went down in a very straight line, as you can see here, year after year. And even today, we have less than 0.5% of bankruptcies instead of 2%. So why is this happening? Because we artificially keep these companies alive through subsidies. And the subsidy is called zero interest. So these companies no longer have to earn their capital costs. The demand for their products is kept alive by all kind of artificial measures of monetary and fiscal nature. It's like, again, metaphorically speaking, it's like a truck that's given to us and the result is that far fewer companies fail than expected. So if you combine the entire data set for the last 10 years, you will find that 12 to 15%, ladies and gentlemen, 12 to 15% more companies should have gone out of business. We have saved all of these 12 to 15% of all companies. They are inefficient and unproductive, and if they are no longer subsidized, then it will turn out that these subsidies have not made them, metaphorically speaking, slim and slender and fit, but through sugar and fat, their obese bodies became even more obese. The problem is that at some point the market, and this is now very important, at some point the market will send a signal. Well, the market sent already a signal. What was the signal? Coronavirus. That will trigger all of these safe companies to go bankrupt like a big unstoppable tsunami. And this is also the reason why there is no interest rate increase in Europe. In 2018, the ECB, so the European Central Bank, told us that we were experiencing a boom and growing rapidly, which makes me wonder what's so great about a 1% growth that we had in 2018. There must be some mistake, right? So by the way, in the last quarter of 2019, and this is just only an example, Germany itself reported a GDP growth of 0%. But in the same quarter, the DAX, the German index, made all-time highs. So this doesn't fit, this doesn't match. So I have to go one slide back. Again, I say here. So this ever-growing corporate sector of zombies then accumulates in the credit books of the banks. So these companies, ladies and gentlemen, are all borrowers. Ironically speaking, they're even particularly hungry for credit. Therefore, the European Central Bank, the ECB, can never raise interest rates. And with the alleged boom in 2018, they would have had the best opportunity to finally raise interest rates, or at least to stop the negative nonsense. But this has not been done because the ECB knows very well that a rate hike will trigger a financial tsunami and kill all the zombies, the inefficient companies, right? Zombies all at once in a very short time. So how do banks, now this is a very important lesson, and by the way, you don't have to understand the point here, I just want to convey the message of this slide. You don't have to, I will explain it properly, but you don't have to understand everything I'm saying. That's not the point. But the teaching point at the end of the slide is very important, and I think that will get pretty clear. So how do banks earn in normal times? So 80% of banks' revenues in the European commercial banking system, actually in the commercial banking system worldwide, not only European commercial banking system. I don't know if there are any bankers in the room, but you might know what I'm talking about, comes from so-called interest margins. The remaining 20% comes from things like account management fees and bank transfer fees and other admin or transactional fees. So what are interest margins? To do this, you must briefly familiarize yourself with the concept of the yield curve. Okay, a yield curve that forms freely on the market looks like this here on the slide. Short-term loans are cheaper than long-term loans. Why? Pretty self-explanatory. It's simple. If banks lend money long-term, it is riskier than if they only lend it for one day. Because banks have liquidity risks, interest rate risks, and other credit risks. So in normal times, banks do not charge 1% for the 10-year loan, but maybe 4%. And overnight money, so for the short-term money, then maybe 1% or 2%. So that means the longer the loan runs, so the longer your loan runs, the higher the interest you pay. this yield curve, which is freely formed, which forms freely in the market, is the basic prerequisite of the business model of our entire banking world. So this yield curve you see here is literally the basic prerequisite of the entire business model of the business model of the entire banking world. And this is because 80% of banks' earnings come from exactly this element. So now imagine the following, that in the short term, the interest rate would be 2%. You take your money to the bank. The bank then gives you 1% interest on your savings account. The bank can invest it overnight on the interbank capital market and gets 2%. So the bank has already earned 1%. And this is the so-called savings margin. Now, the bank comes now along and says, we don't just lend money overnight over and over again. Let's put it. I'm just looking, so everybody can hear me, right? Because I see some might face an issue, but I think the sound is okay. I just continue. Let me know, please, if the sound is not if you cannot hear me properly. So where did I stop? So so now the bank comes along and says, we don't just lend money overnight over and over again. Let's put it into 10-year building loans or investment credits. So the market rate for this is perhaps 5%. So the bank has just earned a 3% transformation margin. So this means that the money invested in the bank in the short term is tied up in the long term. So the bank takes the risk that everyone may come at the same time wanting their money back, a so-called bank run. Well, I mean, this is usually only happens when the existence of the bank is in question. So very, very unlikely scenario. So in normal times, right, this does not happen, unlikely scenario. So this means that this risk is calculable for the bank, even though long-term interest rates fluctuate a bit from time to time. What must not happen though is that the short-term interest rates become higher than the long-term ones. This can happen usually shortly before recessions. And this is the so-called inversion, and you might have heard this in the news, right? This is the so-called inversion of the yield curve, and this can be then observed, the inversion of the yield curve. However, this is also very rare. This is a very rare case as well. But now, this is actually the important point I want you to take away from this slide. That's my teaching point here. An inverted yield curve, ladies and gentlemen, is a warning signal that the economic cycle is moving into a recession. Now, the third interest margin that we haven't talked about yet is the so-called credit margin. So depending on the creditworthiness, the creditor must pay a risk premium. So the savings margin, transformation margin, and credit margin thus account for roughly, as I said in the beginning, 80%, so 80% of the bank's earnings. So the banks must deduct their costs from this amount, and when they have paid all costs, ideally, there should be something left over, because the bank is a company that has to make profit. And ladies and gentlemen, a bank is not different to the supermarket next door or the whatever store in the mall you're going to. It has to make profits to survive. A bank is not different. If a bank doesn't make profit, it goes out of business. So what happens now to the profit situation of the banks? Now, this is today's scenario. So what happens to the profit situation of the banks in the world of zero interest or in the world of the European Central Bank? And this is so important to understand. At the short end, interest rates are at minus 0.4%, minus 0.4%. And at the long end, they're at 0%. Along the zero line, you see here that the yield curve looks different. At the short end, along the zero line, this yield curve is now flattened like a pancake, like a turtle run over by a truck. So you take your money now, you take your money to the bank with minus 0.4%. The bank does not pay you any interest, right? But it does not take any from you either. This means that at the moment the bank receives your money, the bank already lost 0.4% of the total amount. Okay, now the bank, what could the bank do now? The bank could lease its money for 10 years at a transformation margin of 0.4%, but actually it cannot do that. Why? Because the risk it takes in doing so could kill the bank. Imagine you are the bank now. Imagine you are the bank. You lend money for 10 years. Now, the short-term interest rate rises because the system collapses. Let's say short-term interest rises to 2%. Now the bank has to contribute 1.6% every year for the 10 years. No bank in the world can do that. And the risk is called the interest rate risk. When the normal yield curve, and with the normal yield curve, the bank can manage and overcome the interest rate risk. With this flattened structure that we see today, the bank cannot bear this risk. So nevertheless, banks are still taking this risk in order to sweep the last bit of dust out of the corner and lick it up. So they don't have to admit complete failure and throw in the towel right away. Basically, just delaying the inevitable. Okay, so, and what about the credit margin now? When you look at this shape of the yield curve, you will find that the credit margin is independent in the shape of the yield curve. Normally, the credit margin should go on top of the other margins. Normally, today, also the credit margin is decreasing. Why? Well, because the banks have lost the other two margins, but are unable to control their costs, and they are unable to reduce the costs at the same pace. So naturally, they say, I have to compensate for that somehow, but they can't compensate for it by increasing fees. Why are they not able to, why are the banks not able to increase fees? Also pretty clear, because the PayPals, Apple Pays, Google Pays, whatsoever of this world are already lurking there. So they put everything into the credit market and try to make up for the collapse in earnings by granting more loans. So, and this is economics 101. What happens, ladies and gentlemen? What happens when everyone flows into a credit margin, creating increasing supply of credits, but demand does not increase at the same pace? The price drops, right? In this case, the price of the credits. In other words, supply and demand determine the price of the loans, which is no longer risk adequate. Conversely, this means that all three margins are falling. Slowly, but surely. So now, what is the result of all this, what I just explained? On this chart, you see the result. What you see here, I have the data for the entire German banking sector, but this is representative to the entire European banking sector, okay? So what you see here is the entire German banking system lined up. Each pillar, you see here the hundreds of pillars. Each pillar is a bank. Now, let me get again my laser pointer. It's still here. It's still here. So now, down on the x-axis, you can see the width of the columns. So that's the size of the bank. So the big fat column on the far right, this one here, is the biggest bank in Germany. Well, I don't want to call out the banks here during that presentation, but if you have seen my cover slide maybe, and you will hear the banks I'm talking about after that slide, you might can imagine what's the biggest bank in Germany, right? So the biggest one here, that's the biggest column, that's the biggest bank in Germany. So on the other axis, you can see here on the other axis, you can see the cost income ratio. So 100% cost income ratio, you see here 100%. 100% cost income ratio means the costs are as high as the revenues. So 100%, ladies and gentlemen, important, very simple. 100% means the costs are as high as the revenue. So basically, you're break even, right? So the banks here on the right, and by the way, this chart now here, you see, represents this higher line, represents the end of 2017, okay? This represents now the end of 2017. So the banks here on the right? So you see that here, a few banks here on the right, end of 2017, so 3 years back. On the right, so the banks here on the right already have less revenues than costs. If you have less revenues than costs, well, you're negative. So they are generating losses. Then they are sort all the way to the far left, right? All the way to the far left, and you can find the banks that come best. So here are the banks that still make a lot of profits, right? As I said, I'm not calling out any of these banks, but you see here, end of 2017, you had a few banks that already were in the negative, making losses, and here all of them are still positive. So now imagine the following. Now that's the tricky part. Now you subtract 10% from the income each year and assume that the banks are not able to save 10% of the costs. Now this line, this 100% line, right? Slowly, here, slide slowly down, right? This is the 100% line, end of 18 was here. End of 2019, the 100% line was already here. And end of 20, it's going to be here. End of 21, it's going to be here. So now this 100% line here, as I said, slides slowly down, or in other words, from right to left, right? From right to left. The banks slide into the loss zones. So these banks who were still profitable, once this 100%, once this cost income ratio slides down, these banks slide into losses. And we are now end of 2019. So all of these banks here are in a loss zone. And I will point this out in a second. So in 2018 and 2019, the banks here, now these banks, all these banks here are now really deep in the red because their earnings continue to collapse. If the banks post losses, this has an implication because these losses can only be covered from exactly one source, from the bank's own equity capital. So to cover their losses, the bank's equity is shrinking. But the banks need their equity to be able to grant loans. No equity, no loans. Very simple. Banks are required by regulation to provide a security of risk-adjusted capital to every loan they give out. In this way, the banks secure themselves against credit default. This makes a lot of sense, by the way, because practically this acts as an internal insurance policy. So today, the equity ratio of the banks, is 12%. However, it is not the kind of equity ratio you might know if you're familiar to all of that. So that's not the equity ratio you know from a normal company. Rather, it is formed from risk-adjusted assets on the balance sheet. So what does that mean exactly? It's very simple. Let me make an example. So for example, let's take a bank has given out 100 billions in loans, so 100 billion euros in loans. Let's say the bank has 12% equity, 12% equity ratio. Then you would have to assume that the bank has an equity ratio of 12 billion, right? 12% of 100 billion equals 12 billion, right? Well, that's not how the analysis goes here. The 100 billions in loans are actually first sorted according to risk content. If the risk of the loan is low, then it gets a discount. And on average, the discount is 75%. This means a classic situation looks more like this. The bank has granted 100 billion euros in loans. Adjusted for risk, however, it has only 25 billion risk-weighted average, right? 75%, that's discount. Now it only has to show 12% of these 25 billion risk-weighted assets. So in reality, it only calculated 3% of the 100 billion. So a bank that can no longer meet even these 3% because it must cut back on its lending. And what happens when the bank cuts back on its lending? Let's look at that in a little bit. Now, today, that's what we call the race between costs and revenues. Today, banks fight against the race between costs and revenues. Here using the example of the Deutsche Bank. So who could be the biggest bank in Germany? Question to you guys. So here we use the example of Deutsche Bank. You can see the following, guys, and that's so important to understand. Here are the costs and revenues of Deutsche Bank from the first quarter of 2013. You see it here, to the fourth quarter, all the way to the right, 2018. With the red line representing the costs, you see it here, and the blue line representing the revenues. So you see both go slightly down, but the blue and the red trend lines go down with a different steepness. You can very well observe how the revenues fall faster than the costs. So in the first quarter of 2013, everything was still shiny and rosy somehow. This bank, so Deutsche Bank, had 9.5 billion in revenues and 6.5 billion in costs. So the result is a profit of 3 billion. So pretty decent result. Now let's go all the way to the fourth quarter of 2018. And that's the result of the zero interest rate policy. In the fourth quarter of 2018, it had 5.5 billion in revenues and 5.6 billion in costs. And therefore, so if you have 5.5 billion in revenues and 5.6 billion in costs, you have a loss of 100 million. Right now you're in a negative. And listen to this carefully. That's the whole teaching point here. This is the takeaway. For the year of 2019, Deutsche Bank had reported a loss of 5.7 billion euros. Ladies and gentlemen, 5.7 billion euros negative, a loss in end of 2019. So share prices, now let's compare the share prices versus balance sheet of Deutsche Bank and another interesting bank, Commerzbank. And by the way, ladies and gentlemen, why are we talking about these two banks? Also, well, with equity, right, if you check on the website, we can trade these two banks. And that's going to be interesting because in the second session, we're going to look where we can short these two banks, okay? So stay tuned. We're going to point out some levels, entry, stop loss targets, where we can short these two banks. So these are the share prices of Deutsche Bank and Commerzbank from January 1st, 2018 to December 31st, 2018. So in just 1 year, the valuations of the banks in terms of market capitalization has halved. So the interesting thing is that these examples demonstrate that the financial market, the stock market here in that case, the financial market has long been smelling the rat I'm showing you today. The balance sheet value of Deutsche Bank, that is the equity capital, which we have just talked about in detail, the 12%, is 63 billion euro. So Deutsche Bank has a balance sheet though of well over 1 trillion euro, or in other words 1,000 billion euros. So here you can already see that this is not 12% in relation to the balance sheet total, but only half of it. So, well, 63 billion is a lot of money, but the market believes that the bank is worth only, you see that here also on the slide, that the bank is worth only 15 billion as per the stock market, as per the financial market. So you have to ask yourself now, why the bank is only worth a quarter or less than a quarter basically of the value of its capital on the balance sheet as per the financial market. So in any case, the balance sheet capital means that if we buy this bank, if we now go out and literally physically buy this bank and we sell all the assets and pay all the debts, there will be 63 billion left. That means, guys, how many people are we in the room? Roughly 250 people today. So we can just pass the collection bag around and scrape together 15 billion, and then we buy the bank for 15 billion. So then we simply close the doors, because obviously the business, as we have seen, this business model is not doing very well, and then we cash out and go home with almost 50 billion euros in profit. That sounds like a decent business case, right? And by the way, why doesn't anybody do that? Because there are enough institutions out there who have that amount of money. Because the market, as we can see here, believe that one of the 63 billion, that basically out of the 63 billion, 48 billion have already been burned for risks that have not been accounted for income that does not come, and for costs that cannot be brought down. And it is exactly the same at Commerzbank. The balance sheet value is 30 billion euro, and the market valuation in terms of market capitalization only 7.7 billion euro. And then of course you ask yourself, if the markets see it that way, why isn't anyone else concerned about this? So where do we go from here? The bill that is coming up is devastating, and unfortunately it's financially not feasible. The zombie companies have received about already 1,500 billion euro in loans. When bank earnings fall to the point where the equity of the banking system shrinks, this acts like an interest rate hike. Then, in a huge tsunami of companies failing, the zombies will go bankrupt. This is a wave of bankruptcies, of zombies, that even the central banks cannot stop. This is because the central bank can only provide the banks with liquidity. So, for instance, debt capital. A lot of it, but this is borrowed capital and not equity. So the central bank does not have a way to strengthen the bank's capital base. It can only give them outside capital in any quantity though. The banks can only convert this borrowed capital into loans if they have enough equity capital. So these about maybe so far 1,500 billion euro in loans, maybe now during the Corona crisis already, maybe 1,800, 200 or 2,000 by now, nobody knows for sure, are then exposed. So now, what happens if these 15% of all companies in the European Union, we're not talking Germany, we're talking European Union, what happens if these 15% of all companies then go bankrupt? Well, so back to the question, what happens when the bank cuts back on its lending? In this case, these 15% of zombies will go bankrupt now within a time frame of a few quarters. 15%, ladies and gentlemen, 15% of all companies go bankrupt. 15% of all people become unemployed. 15% of all real estate that served as collateral for these loans come onto the market. And on top of that, we already have 1,000 billion euro in defaulted loans in the European banking system. These 1,000 billion loans have already defaulted. The banks gave those loans to companies, to homeowners, to business owners or entrepreneurs and so on. And they are not written off yet. So Mr. Enria, he is the head of the almighty European banking supervision, once gave an interview in the Handelsblatt, a German newspaper. In this interview, he admits that we have these 1,000 billion euro of bad loans. So the European banking system has about 2,500 billion euro bad loans. However, they only have about 1,500 billion in equity capital. All European banks taken together do not have more equity. This means that we have a total bill of 2,500 billion euro of bad debt in the European banking system. This is the gap in capital that we would need to fill to save the European banking system. But the housing bubble of 2007, in course of which the famous Lehman Bank collapsed, you might have heard about this as well or read about that. And so the Lehman Bank, this is where the Lehman Bank collapsed and other banks were saved, has provided us with actually a very interesting data point. Once a bank is keeled over, you need actually 3 times the amount of money to save it. And if you do it before, you just have to put in the initial amount because people still trust the bank. But if the bank has keeled over, then you have to put in 3 times as much money. You have to put 3 times as much money so that people don't go on a so-called very rare occasion, right? We talk about this bank run and withdraw all the money. So this means that we do not need 2,500 billion. We need 3 times the amount. We need 7,500 billion to save the European banking system. And this is the bill then that the European taxpayer gets served. So when now the zombies and the banks collapse, then we will have a deflationary phase. And this deflationary phase will cause panic. So now you might ask yourself, most probably you're from the Africa region, you're from Kenya, you're from the Middle East, and you might ask yourself, hey, why is he talking about the European Union? Why do I care? Well, this is a question I get asked very often. So if this crisis does occur, will it be global? So if so, what does it mean for other economic areas? Think about it. If the crisis global, well, the answer is clearly yes. You cannot cause, and that's very important. That's the whole teaching point here. You cannot cause the largest or one of the largest economic areas in the world to collapse in monetary terms and then assume this will not cause a global crisis. If the euro collapses, this will lead to a global economic crisis. So now, ladies and gentlemen, last but not least for the first session here. Now, in which phases will this crisis unfold and how will these phases consume citizens' wealth? So the question here is, what happens next? And I have now taken the trouble to try to show you how this crisis could take place. But please keep in mind, there are so many crossways and possibilities on how this can unfold. The following now is an attempt to show you how this could potentially unfold. It is obviously, guys, this is obviously not my first time talking about this crisis. We are warning people since April 2019 Well, we have written plenty of articles that you find on our website about this, starting from April 2019. We have been warning people since April 2019 that this is going to happen. So I created this slide obviously before the coronavirus even happened. So the coronavirus as a trigger. So the coronavirus is a trigger, but not the cause of that. And this is very important. This would have happened anyway, what is happening now. Now the coronavirus is just accelerating all these events. So our initial analysis said that the crisis is expected to start at the end of 2020. And this is where you see here the beginning, at the end of 2020. Now, I keep it here, my laser pointer. So now, because of that unexpected trigger, right? I mean, that coronavirus was an unexpected trigger, to say so. Everything that I just described will happen, might happen 1 or 2 quarters earlier. So this black bar you can most probably put here, or now even already now starting actually already in Q2. Now we are just now, right, because we are basically just now entering a nice recession and all indicators are bad. In Europe, we have a yield curve that is slightly inverted, slightly inverted below zero for the first time in human history. And as we have already discussed today, an inverted yield curve has been seen many times before. This is nothing new, but this has always been, but it has always been a sign of a coming recession. The fact now, ladies and gentlemen, the fact that it can also invert below the zero line is, however, something completely new. And I'm afraid the inversion of the yield curve has lost a little of its significance even below zero. And that means we are going into a recession, and that recession is going to be relatively severe. So just because we haven't seen a recession for several years now, because we have always covered everything up with cheap money and prevented every adjustment crisis since 2009. Metaphorically speaking, guys, the harder you party, the worse your hangover is going to be the next day or even for a few days, right? So all in all, taking all these factors into account, the end of 2020 plus or minus, rather minus 2 or 3 quarters, is the likely time frame where we're gonna see the beginning of what I just described. Then we're gonna jump into the deflationary phase. So then the deflationary phase will begin. This is the gray line. You see here the gray line, the green bar, basically. This is before the 4th quarter of 2020 until the end of basically the end of 2021. For instance, what's going to happen? Falling prices in broad ETFs such as DAX, S&P 500, Nikkei, and all other indices. Again, we are looking where we can short these indices in the second session of today. Companies, stocks, even companies that are doing well are usually hurt by recessions, right? And we're going to look also in the next session, where can we short Deutsche Bank? Where can we short Commerzbank, or maybe even Citibank, a US bank? So safe haven assets like gold and silver, by the way, can also be deflationary, meaning you cannot just go out there and just buy gold. We're going to look at certain areas where we can buy gold and silver in the second session. So housing and real estate is going to lose also massive value. It's not the time to buy real estate now, ladies and gentlemen. So why? It's clear. Supply and demand. Imagine, guys, 15% of zombies go bankrupt, 15% of people unemployed, 15% of real estates come to the market, which creates an abundance of supply. An increased supply meets a diminished demand, because who wants to buy in a crisis? Therefore, prices have to fall. I don't know about you guys, but I don't want to invest my money in anything that is deflationary and watch maybe 2 years of falling prices and watch my money being eaten up 50%. I want to sleep well at night. So this deflationary phase will consist of 3 elements. And we have no, by the way, we have no empirical data points on this. So remember, this is only a guesstimate, but it's an educated guesstimate. Okay. So, however, it could go as follows. First, the zombie crash spiral. 2 to 3 quarters after the zombie bankruptcy spiral has started, we see the first banks failing, which could be Deutsche Bank, right? Shortly thereafter, a wave of bank failures. So the first bank bankruptcies are still being cushioned by the fact that the states rescue the banks following a traditional pattern like we have seen 2007, 2008. So the states will spend money. They're going to rescue the banks, and then they realize, though, the first bank heals over, the second bank heals over, and with the third bank, well, the government is gradually getting uncomfortable, because then they would say, well, this is slowly cutting into our fiscal capacity. And then at some point, they will realize that they can't do that anymore. So during the last crisis, right, the state, they used tax money and state guarantees to rescue banks. This time, this will not be the case. And this is because we are not just talking, this time you have seen the chart, we are not just talking about 1 or 2 banks. There will be simply too many banks in the red that have to be saved. So now the next phase, then here, we see here starting somewhere end of 21, beginning of 22. Again, that's an educated guess and guesstimate. There's no empirical data point on that. So then comes in the inflationary phase, then comes the ECBs, the European Central Bank's so-called bazooka. Actually, we see that already now with the helicopter money. That's a different topic, but that's what I'm talking about now. Namely, that the bank bailout must be done using ECB money. This will probably start somewhere in the 3rd or 4th quarter of 2021. In this case, we will enter an inflationary phase. And this is the second large gray bar. I just pointed it out. It's here, right? Also, and which will begin around the 1st quarter of 2022. So this phase will swing up relatively quickly, because the amount of money that is pumped into the circulation is simply too large. If we have a 2,500 billion euro gap, we need 3 times as much money for the bank bailout. And then we are talking about 7,500 billion euro in fresh money. This means that we have nationalized the banks. We will have 15% unemployed, at least at that time. Politicians will therefore be crying out for economic stimulus packages to create demand. And then money is pushed into the market through loans, through helicopter money, right? We see that right now, helicopter money, through whatever. And that will, of course, mean that this money will be demand effective. And when it becomes demand effective, we have doubled the money supply. This means doubling of price levels. We are talking about 50% inflation per month. After 3 to 4 months, your savings are gone. Bonds denominated in euro have disappeared into thin air. We are talking about a bond bubble here as well. That would be a topic for a completely different webinar. So savings, life insurance, pension funds are all going to be zero. And ladies and gentlemen, at the latest, then the euro will break apart. And that's because a euro that has virtually expropriated all savers on the continent will no longer enjoy political capital. And then comes the expropriation phase, the last phase of this crisis, where it's basically then comes the expropriation phase of the real property. It could look that way: forced loans on real estate, a property levy, taking away gold, all these wealth tax elements that then come into play. So this is practically the 3rd phase of expropriation. So now you're probably wondering, Now you're probably wondering why this will or must come. So after the euro fails, the national banks, such as the Deutsche Bundesbank, for example, must create new currencies. But they can hardly create a credible and stable currency if they are over indebted. So this means that the central bank must recapitalize. So now, big question, and this is basically kind of now stretched or overlapping with the next session. How can you protect yourself? Or how can you even benefit from it? Now, why did we just discuss these scenarios in such detail? It's very, very simple, because an incredible amount depends on it, especially in terms of the question of how we invest our money and shift our money in the crisis. How do we protect our hard-earned assets and capital? And obviously, there's no static recommendation what we could do with our money. This is because this crisis will have so many ramifications, so many phases, deflationary and inflationary phases, and creative expropriation methods used by the state. That's why it's so important that there is not a single solution that says, I'm making this investment now before in the crisis, like say, I buy gold and I'm good until the end of the crisis. No, that's not the case. And after the crisis, I still have all my money. That's not how it's going to work. We must proactively take control over our money and reallocate it even during the crisis. Topics like shorts in specific currencies will be very interesting, right? Because we have just learned that it's very likely that at some point of time, the euro is going to break up. So let's look to short the euro, buying gold before the inflationary phase. So we should now looking to buy gold as well. We're going to do this in the second session. This is because the central bank is likely to increase its gold reserves. In the deflationary period, we should look to short broad indices, individual zombie companies, and bad banks. Again, we're going to do this now in the second session. Let's look to short the S&P 500. Let's look to short DAX. Let's look to short Nikkei. Let's look to short Deutsche Bank, and so on. And after the crisis, we can investing your secured and increased money in good companies, stocks, assets. Remember, this is where you, as a proactive investor, can catch up in terms of accumulating financial wealth. Unfortunately, I have to say, the fact is that without professional help, the ordinary citizen, right, taxpayer and homeowner, will find it very difficult to save his family and to save his hard-earned assets from this very likely economic meltdown that we're now going to face. And we want and can earn money in all phases, and through a multi-asset trading strategy, we can adjust our positions as required. So with longs and short and trading futures, forex and stocks, we are very well equipped to see even this crisis as an opportunity for us to increase our assets. So that's it for the first session. I would say now I exceeded a little bit my time. Doesn't matter. I think this was very important that that I explained this in very detail what's going to happen next. So let's have a 10-minute break, guys. Again, I see you might have a lot of questions. I don't have time. Look, we have 250 people in that room. I don't have time to focus on all the questions. Otherwise, we would sit. There would be not a structure. This would be not a structured presentation whatsoever, and we would sit here most probably the whole day. I would love to answer all your questions. Don't get me wrong. So shoot us a message if you have like a question. info@onlinetradingcampus.com. We are always happy to help you out, and go on our website. We have plenty of free articles about this topic as well. So please feel free to contact us.